Fintech could disrupt finance. Banking is currently inefficient, costly, and riddled with conflicts. Information technology has disrupted the entertainment, media, and retail businesses and, most recently, the supply of hotel rooms and taxis. Is it going to do the same to finance? My first response is, please. My second response is, yes. As Bill Gates has said, we always overestimate the change that will occur in the next 2 years and underestimate the change that will occur in the next 10. Don't let yourself be lulled into inaction. This advice applies to people in the business itself, but also to policymakers. Finance is an information business. Indeed, it already spends a higher share of its revenues on information technology than any other. It seems ripe for disruption by information technologies. Consider its 3 essential functions: payment, intermediation between savings and investment, and insurance. All these activities are information intensive. People need to know accounts have been settled. They need to understand how their wealth is being employed and to know that their risks are covered. Not least, the intermediaries need to understand what they are doing. Today, banks and insurance companies are the core financial institutions. Banks manage payments systems, create most of the economy's money, are responsible for a large proportion of financial intermediation, are creators of financial instruments and act as market makers and agents. Similarly, insurance companies play the central role in assessing and managing risks. Why might one hope that new financial technology, or fintech as it is known, will transform these businesses? The answer, especially for banking, is that they are currently not done very well. Banking seems inefficient, costly, riddled with conflicts of interest, prone to unethical behavior, and, not least, able to generate huge crises. In a recent speech on the possibilities for a financial revolution, Andrew Haldane of the Bank of England notes that, astonishingly, the unit cost of U.S. financial intermediation seems to be unchanged over a century. See chart. Moreover, income from finance simply rises and falls with the value of assets. That suggests a huge amount of rent extraction. Additionally, 10 US households and 1.5 UK adults still have no bank accounts. Worldwide, banks generate a staggering $1.7 tn in revenue, 40% of the total, from the job of making payments. In the computer age, settlement can still take hours or days. On behavior, as John Kay has written, parts of the financial sector today demonstrate the lowest ethical standards of any legal industry. The payment of vast fines seems to be viewed as just a cost of doing business. Finally, the post-2007 banking crises were as big as any in the past. That their economic impact was not still worse than earlier was due to the willingness of governments to bail banks out. New technology might help change this in at least 2 ways. First, it might transform payments. One possibility is real-time settlement via distributed ledgers. The advantages of instantaneous settlement are evident. The advantage of distributed ledgers, an element in Bitcoin's blockchain technology, is an improvement in the robustness of record keeping. Instead of centralized accounts, the database would be shared across a network of sites, all of which would hold an identical copy. Such technologies might revolutionize domestic and foreign payments. Many businesses are already pursuing this possibility. A second transformation might be via peer-to-peer lending, in which new platforms disintermediate the traditional businesses in matching savers with investments. Such lending is growing rapidly, see chart. The theory here is that computerized information might allow savers to dispense with the costly services of bankers altogether. Optimists imagine a future in which payments, the creation of money, unquestionably liquid and safe assets, and intermediation would be separated. In this case, the capacity of the banking sector to create havoc would be reduced, and so would the perils created by the state's backstop to private institutions. It is, however, far too early to be confident of such benefits. Indeed, it is easy to see that new record-keeping and payments systems would create huge security issues. Similarly, opportunities for malfeasance also exist on peer-to-peer platforms. Indeed, these are inevitable with transactions that rest on promises against an inherently uncertain future. A further potential source of transformation is via big data. That might transform the quality of lending, for example, which would be a good thing. But the most striking effects are likely to be in insurance. With new monitoring devices, insurers might gain direct knowledge of the quality of driving or of the state of their clients' health. Such information might be used to motivate improvements in behavior. But it is also possible to imagine improvements in information so profound that risk pools, the basic building blocks of insurance, disappear. If, for example, the insurer knew with a high level of certainty that some customers would get a given disease, that person might become uninsurable. In insurance, some ignorance is bliss. At the least, the way in which knowledge is obtained and used could create huge social questions. On balance, the opportunities afforded by the application of information technologies to our financial system seem large. The difficulty might rather be to ensure that the benefits accrue this time to the public rather than to a small number of incumbents or even to their more dynamic replacements. Finance, particularly banking, does need a revolution. But this is one area where policymakers cannot just assume things will work out well. It is because finance is so important that a revolution is needed. But for that very reason, the revolution also requires careful watching. Banking execs fear risk due to fintech innovation and disruption. Top banking executives fear that up to a quarter of their business could be at risk from emerging fintech firms, according to research conducted by PwC. The report notes that information on fintech is somewhat dispersed and obscure, which can make data synthesizing challenging. PwC's findings are based on de novo insights and the views of survey participants, highlighting key trends that will enhance customer experience, self-directed services, sophisticated data analytics and cybersecurity. Fintech is changing the FS industry from the outside. PwC estimates within the next 3 to 5 years, cumulative investment in fintech globally could well exceed $150 billion, and financial institutions and tech companies are stepping over one another for a chance to get into the game, commented Steve Davies, PwC EMEA fintech leader. As the lines between traditional finance, technology firms and telecom companies are blurring, many innovative solutions are emerging and there is clearly no straightforward solution to navigate this fintech world. For the study, Blurred Lines, How Fintech is Shaping Financial Services, PwC interviewed 544 CEOs, heads of innovation, CIOs, and top management involved in digital and technological transformation across the financial services industry in 46 countries. Disruption of the FS industry is happening and fintech is the driver. It reshapes the way companies and consumers engage by altering how, when, and where FS and products are provided. Success is driven by the ability to improve customer experience and meet changing customer needs, noted the report. Some statistics include, incumbents believe 23% of their business could be at risk due to further innovation in fintech, with traditional banking and payments feeling the most heat. Respondents from the fund transfer and payments industry anticipate that in the next 5 years, they could lose up to 28% of their market share to stand-alone fintech companies, while bankers estimate they are likely to lose 24%. This compares to around 22% in the case of asset management and wealth management and 21% in insurance. 2/3, 67%, of incumbents ranked pressure on profit margins as the top fintech-related threat, followed by loss of market share, 59%. Fintech companies are more bullish, believing they could capture a third of incumbents' business. The release cited a report by McKinsey from last year that forecasted that as much as 60% of bank profits in 5 retail businesses, consumer finance, mortgages, small business lending, retail payments and wealth management are at risk from a combination of shrinking margins and competition from fintech startups. Indeed, PwC's survey shows the most widespread form of collaboration with fintech companies is joint partnership, 32%, which, says Davies, is indicative of a reluctance among incumbents to go all in and invest fully in emerging technology startups. Asked what challenges they face in dealing with fintech companies, 53% of incumbents cite IT security, regulatory uncertainty, 49%, and differences in business models, 40%. In the case of fintech companies, differences in management and culture, 54%, operational processes, 47%, and regulatory uncertainty, 43%, are deemed the top 3 challenges when dealing with traditional financial services firms. The report concluded. In response to this rapidly changing environment, incumbent financial institutions have approached fintech in various ways, such as through joint partnerships or startup programs. But whatever strategy an organization pursues, it cannot afford to ignore fintech. The main impact of fintech will be the surge of new FS business models, which will create challenges for both regulators and market players. FSRMS should turn away from trying to control all parts of their value chain and customer experience through traditional business models, and instead move toward the center of the fintech ecosystem by leveraging their trusted relationships with customers and their extensive access to client data. For many traditional financial institutions, this approach will require a fundamental shift in identity and purpose. The new norm will involve turning away from a linear product push approach, to a customer-centric model in which FS providers are facilitators of a service that enables clients to acquire advice and interact with all relevant actors through multiple channels. By focusing on incorporating new technologies into their own architecture, traditional financial institutions can prepare themselves to play a central role in the new FS world in which they will operate at the center of customer activity and maintain strong positions even as innovations alter the marketplace. FIS should make the most of their position of trust with customers, brand recognition, access to data and knowledge of the regulatory environment to compete. FS players might not recognize the financial industry in the future, but they will be in the center of it.